We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Kevin Wadsworth from NorthstarBadCharts.com. Thanks for joining me today, Kevin.
Hey, Tom. Great to be here.
Of course, we're speaking this morning on Monday, the 9th of August, and we saw both gold and silver prices get hammered pretty good on the Sunday night. So we have a couple charts to go through and talk about, you know, what happened, if trends are broken, everything like that.
Yeah, you can't even go to sleep these days without something happening whilst you're asleep, can you? Okay, Tom, I'll share my screen and we can take a look and try and see what's going on, shall we? So here's the silver chart. I went to bed last night and everything was absolutely fine. I woke up this morning, it was down about 5 or 6% or something, but it's bounced back up a little bit since then. What you can see here, this silver arc or cup pattern that a lot of people sort of refer to, these cup and handle patterns. You can find them all over the technical analysis charts, and when they cover a period of several years, like this one does from 2011 to today, and you get several confirming touches on the arc, then it gives you a high level of confidence that the arc will guide you up to the top right-hand corner. The success rate of these sort of arcs is, in my experience, somewhere around about 90%. Actually, of course, you do get the odd one that fails from time to time, but they are pretty reliable chart patterns. Silver's been consolidating in a box for a while, with the bottom of the box somewhere around $21.50, and I suppose the top, if you look at the spike highs, somewhere very close to $30. So quite a range there, but it's been bouncing around ever since we peaked last August. More sort of putting a bit more detail on that, we've actually had an uptrending line since we hit the lows back end of last year, early this year, and that's what we've just broken down below, actually, and that's one of the sort of technical reasons why prices sort of plunged so quickly. And we're forming, or have formed, sort of three these low points here are very close together. In fact, I think they're even closer together on gold when you look at the gold chart. But so it's almost like a triple bottom sort of thing that's forming here. But from a technical point of view, there is further downside possible. I always say to people that the edge of the arc here will be tested at some point. So obviously it depends when the price comes to the edge of that arc. It could be anywhere between, well, if we drop vertically now, it's somewhere around about $17, but I'm not expecting that. We could quite easily come down to the 3-year moving average, this green line here, which is around about 19, 20, well, 20, approaching $20. And there are other targets using other methods around sort of $20, $21, that kind of area, $21.50, you can see on the bottom of the box here. So I think the downside from here is maybe about 10 or 15%, looking at the current price as we speak. But the upside, of course, is much higher. So short-term weakness is certainly the message, and longer-term strength appears to be the order of the day. Looking at the Ichimoku cloud as well, that's this sort of red and green strange blobs you see on the chart here. My good friend Patrick uses these quite a lot, and they can be very useful. Once you break through them, they very often, as you can see on the left-hand side of the chart, act as strong support even when you go down through the 3-year moving average. So we've got that below us around the edge of the arc as well, and it's climbing all the while. So reasons to be optimistic in the medium to long term, but short-term weakness certainly looking likely. The gold chart, as I've mentioned, a bit more of a sort of perfect triple bottom there. You can see around about the 1665 to 1670, or was it 1670 to 1675 area, around about that very sort of zone there where we had sort of resistance and support back in 2020. Obviously a very important technical area, and prices hit it and bounced off it as if it was red hot. So that's perhaps a good thing. We're in a rising channel, of course, and we also have this potential arc in formation. So a break below the channel and a break below the arc on a weekly closing basis certainly would be quite significant, and I would turn considerably more bearish at that point. But we have to wait and see how the week progresses. And if we close back inside this arc on a weekly basis, then this is just a wick on a candle that kind of shook out some weak hands. So that's how gold is looking on that particular view. Taking a wider view and a longer view since, in fact, since the 1960s.
Kevin, sorry, can we go back to the previous chart?
Yeah,
I just wanted to kind of get a bit more of your thoughts towards breaking that arc, as we saw with that lower candle on the right hand side that obviously we saw for me, and let's say for North America, we saw last night, Sunday night. So can we consider that short-term noise in that longer term chart? And like you say, if it closes back above that, does that really affect the arc?
Good question. These wicks on the candles do set up chart resistance and chart support. When you draw these technical charts, a lot of people prefer to use the body of these candles because that's where the opening and closing prices are. These wicks are just showing the extremities of the price. Mm-hmm. So if you're trading on a weekly basis and you're not sort of day trading, you're not sort of wanting to catch these moves as they unfold. I mean, that's quite a big move, as I say, 5 or 6%. Mm-hmm. There are traders out there who will trade these moves, and there are those like myself who use the longer term charts. I entered gold somewhere down around about $1,200-$1,300, and I haven't touched it since. I'm in for the long haul. With the post 2024 bull run that I'm forecasting. This ahead of that is another opportunity to add to positions, but. The miners are a different matter. If you're talking about gold and silver miners, then that's something else that you need to look at completely separately. But these wicks do set up chart resistance areas that you need to look at. And in fact, just looking at it now, it's quite interesting to see where that spike stopped. If you draw a line across, you can see it coincides very neatly with this resistance turn support line. Way back in, not way back, but back in 2020. Mm-hmm. So these extremities that the price can reach are sort of determined by previous price action. So price can often be smashed down to these support levels and then very quickly rebound back up if the overall prevailing sentiment is bullish and the sort of macro background is bullish. You get these smashes to for all sorts of reasons. Some will call it manipulation, others will come up with all sorts of other reasons. But mm-hmm. on a technical chart, that's how a technical analyst would see it. As long as it closes back within the arc, then the pattern is validated.
And just one more question before we move on there. You mentioned the manipulation, and obviously that's something that a lot of people will point to and say there's no way that that's not present. So I'd like to get your thoughts towards how you think about charting when there's manipulation present. Is that still valid, or how do you feel about that, Kevin?
Yeah, on a short term, the shenanigans that go on at the precious metals exchanges are no doubt a form of manipulation, and paper contracts are bought and sold in quantities that basically beggar belief. And it's not uncommon to have 20-30% or whatever of the entire world's silver supply traded in a very short space of time. You have people with claims on contracts who don't, there isn't enough gold and silver on the planet to fulfill all the claims on. I think we all know that. So it's very much a sort of a paper game, whilst the metal itself very often has much higher resistance to these smashes. If you try and buy silver at that price, you'd be very much struggling, or gold, I should say, at that price, you'd very much be struggling. Same with silver. So the premiums kind of wipe out a lot of this. But when you talk about manipulation, this longer term chart that I was sort of just going on to there, it kind of says in a nutshell what I always go back to is that there's this manipulation that goes on, but as these chart patterns build out, all the manipulation that goes on is very much overridden by the longer term moves. So all this manipulation is going on here on this top right hand corner of the chart, but it makes absolutely no difference to the long term chart. These chart patterns that were set up years ago are still being respected, and these arcs that cover I mean, this one's over 10 years. So during that arc, I suppose about 3 or 4 years ago, I was able to project into the future where the price was likely to go. And prices followed the arc, and all the people that have said, well, you can't draw these sharp patterns because of the manipulation. Well, I don't really know how to answer that, except to say that, the manipulation hasn't made any difference to my forecast. These 8-year cycle lows happen like clockwork. US elections, every 8 years. I mean, the elections are every 4 years, of course, but these major lows are every second election. So 1976, you got one there in sort of 1980, 85. You got one there in 1992. You got one in 2000, 2008, 2016, and 2024. So these low points. That's 1984, isn't it? Not 19. I think I said 1985. But you can see how the elections line up with these major low points in the cyclical pattern for gold. And so, manipulation or no manipulation, these chart patterns are predictable and reliable. Just, the difficulty comes in sort of picking exactly how high or how low that 8-year cycle low is going to be. And we use these chart patterns to help guide us. The post 2024 period is where I'm expecting the major part of the commodities bull run to take over. We've seen it. We've had a little bit of a taste of it with things like lumber and copper, uranium starting to wake up, and the precious metals, of course. But these have a lot further to run. You only have to look at what's going on with interest rates and US debt and all that kind of stuff to realise that this is just the first innings of a much longer game. So that's the roadmap. And my question has been, or what I've been trying to analyze, is whether we're going to see this upwards breakout or upwards move ahead of the 2024 cyclical low. Do we just go down from here into the cyclical low, or do we get this move up to the mid 2000s, which I think a lot of analysts are expecting, myself included, to somewhere between 2300 and perhaps 25 or 2600. The top of this arc is around about 2600, or this orange zone that I've marked on top of the arc here is around about 25 or 2600. So it makes a lot of sense for price to test that sometime in the next 18 months or so, and then begin its descent down into this 8-year cycle low. How low would that be? I mean, it could be sort of equivalent to the lows that we've just seen, somewhere around 1650. In my view, it's probably more likely to come a little bit lower, because it is an 8-year cycle low after all. And the 8-year cycle lows, well, 2008 was one of them. And in 2008, it came down from over $1,000 to a little over $600. So we lost 40%. So if we lost 40% from $2,400, that would take us down to somewhere not too far from where I've marked it there, around about $1,400. Mm-hmm. So for all sorts of reasons, I think that's my most likely scenario. It's not to say that other things can't happen. There are other lower probability scenarios, and of course, low probability events do happen. So, I'm happy that the assessment is correct, that is the most likely probability, maybe 70%, something like that, in my view. But there is also a possibility we go sideways or we go down. Sideways, I would put maybe at a 10% possibility. But because we have this cyclical low here, there's probably a good sort of 20% likelihood at least that we just continue down from here. So it is, this technical chart analysis is not an exact science. It's about assessing probabilities, and this is my most probable scenario. Other scenarios do exist, as they say. So this is the gold-silver ratio, which gives us some clues, Tom. And the gold-silver ratio, when it's dropping, it tends to be a sort of tailwind for precious metals. It's a ratio, after all. So, it's just telling you how the two metals are performing in relation to each other. But as the ratio drops, it's very often associated with precious metals bull markets. If the ratio rises, I mean, what it's saying at the moment is you need 73 ounces of silver to get an ounce of gold. Mm-hmm. And as the value of silver rises at more than gold, then this ratio will drop. So, if you see silver going up more quickly, say silver rises 10% and gold rises 5%, then this ratio will drop. And that's what tends to happen in a good, strong bull market. Until perhaps the later stages. So you have to analyze the stages in the precious metals bull market to work out, what you're expecting this ratio to do. But in general terms, a falling ratio is likely to be associated with gold and silver going up, but silver going up more so, if that makes sense. I'll talk about this indicator in a little while. You see this indicator at the bottom, the Mansfield Relative Strength Indicator. Can be quite important at times. Bitcoin is another one that probably a lot of people are looking at the moment, myself included, and my sort of followers on Twitter and people who subscribe to mine and Patrick's website will be aware that I've been highlighting a particular repeating arc pattern for Bitcoin, which strongly suggested that the Bitcoin bull market wasn't over and that we would progress to perhaps somewhere around $100,000. Possibly more, possibly a bit less, but above the previous all-time highs. That was called into question in my mind quite a lot by the Bitcoin price falling below the 30-week moving average. It's a little bit of a warning sign, that, and I was particularly uncomfortable about that. So I had to acknowledge that there's a possibility that the crypto bull market could have been over back in May when we came down through here. But monitoring this arc pattern as it started to build out, it's just as it started to build out, it was a speculative chart that went along with my other triple arc chart, which people will be able to find on my Twitter account. So we bounced off this, and quite happily for crypto holders, we've bounced up through the downtrend resistance lines, and we're now up through the 30-week moving average. So a lot of the boxes have been ticked now to be able to say with some confidence that we're resuming the cryptocurrency bull market. I would say my confidence level will be much higher if we close the week above the 30-week moving average, and we'll have a weekly close above that. And then I think you can probably declare that we're very likely to be seeing higher highs. This resistance zone here that we're just pushing through at the moment tops out somewhere around 49,000, 50,000, that kind of psychological 50,000 level, and a breakthrough there, and it's pretty much nailed on that will exceed the previous all-time highs. I mean, the ARC target is back at the all-time highs, but once there, I think the momentum will be on our side, and we'll be entering an altcoin season, as people refer to it. So that'll be where altcoins go ballistic. Speaking of which, just for a little bit of a chuckle, there's the Dogecoin chart, one that people either love or hate, but it's pretty typical of a lot of the altcoins at the moment. Again, having broken out through the downtrend resistance line, bounced off the arc, bounced through the 30-week moving average, and it's now bouncing off an uptrend pivot line. This is actually. So we touched that pivot line beautifully, and we've moved up again, consolidating that move. So as long as we're within this arc, and price doesn't fall down and break this arc, which is somewhere around 21 cents, then the forecast remains for Dogecoin to get all the way up to this top right hand corner here. So that's the roadmap. Again, I'll say it again. These are roadmaps. They're there to give us information. They're not there to promise that the price of Dogecoin is going to hit the top right hand corner. They're there to warn us when we're going off track. So that's how that works. And related to there you go. There's another Bitcoin chart there that gives you a different view of things if you like things nice and simple. So I've got it marked there as very good. I could just make this chart a little bit bigger. I remember I said to you earlier on I'd make these charts nice and full screen. There we go. So the Bitcoin chart there, where it came out of the lows in a nice rising channel, and falling out of that channel is not good, but we bounced back above the moving average, 30-week moving average, and we're back into that channel again. Just came down and touched it, and we're moving up. So we're back into my what I would call the good section of this chart. Let's see if we move into the very good section. That'll keep a lot of people happy. See if I can remember to keep making these full screen. So that's cryptocurrencies. As I say, Bitcoin's doing well at the moment, and we'll see how it closes the week. But confidence is rising, I think, across the sector now. Mm. So looking at the US dollar, and I'll just put this in full screen for everybody again. So this is the US dollar, and I'll just readjust the chart so it makes sense. There we go. So we've got this topping pattern, as we saw back in, it was around about 2001. So we've got the topping formation on the US dollar, the inverted arc, which I've been highlighting for a couple of years now. And it's guided the price all the way back down to where we are now in the bottom right-hand corner of the arc. You can put these arcs on, going the other way at the, when we have a basing pattern, and you can have an inverted arc when you have a topping pattern. You very often find that the price tests the arc as you're topping, and also when you're reaching a base as well. So somewhere around about the 93 area is critical for the US dollar. We're pretty close to that area again now, and should we break through 93, I suppose there's a couple of possibilities. One is that we spike upwards, a bit like we did back here in last year. We spiked up to somewhere around about 103 on the dollar index and immediately crashed back down inside it because the price was respecting the arc. If we break out here, we could see another spike that comes up to, well, perhaps it comes up to the 3-year moving average there, somewhere around about 95, or perhaps it goes a little bit higher to a resistance level higher up. But if it's a monthly spike, we close the month back down inside the arc. So again, it's the monthly close at the end of August that's going to be important here to determine the longer term trend. Any move below this channel, we're currently somewhere around about 89, and certainly any move below, I think it was 88.25 was the previous cyclical low here back in 2018. Any move below that, and it's looking extremely bearish for the dollar with much lower downside targets. If you sort of bear in mind what I'm thinking for cryptocurrencies and what may transpire for gold and silver, it may make a certain amount of sense, I suppose, for gold. Now it's achieved its target not gold, for the US dollar. Now that it's achieved its target in the bottom right-hand corner of the arc, it may well make a certain amount of sense for it to climb and for precious metals to struggle for a period of time before the US dollar begins and resumes its drop. So it's timing all of these markets and trying to fit the pieces of this huge jigsaw puzzle together that we're all trying to do at the moment, of course.
So Kevin, is there any indication for you how long, let's say, that downward momentum would take on that dollar chart?
Well, yes, it's cyclical. So you can work out the US dollar cycles, which are around about 15 or 16 years. They're not exact, a little bit like gold's cycle is approximately 16 years. It's around about, I think most analysts would say 15 years, although it does tend to vary a little bit. So if we take the low point as being 2008, then 15 years onto 2008 is 2023. So you'd expect perhaps the US dollar to reach a low point sometime down here in 2023. There are some analysts who believe that the cycle has been disrupted and is sort of, I don't know if the word broken is appropriate to use, but that its behavior is not typical at the moment, and that the US dollar is going to, instead of dropping into 2023, continue to rise, which would be surprising. But we'll get those indications soon, when we see what happens with this arc pattern, and also what happens with the I've moved the chart now, haven't I? But what happens with the channel? But 2023 would be where you'd expect the dollar to bottom. But that's, by the way, that's not when gold peaks. You'll notice here, 2008 was when the dollar bottomed, but gold went on to reach its peak in 2011, where we had this secondary low in the US dollar. So the US dollar rose a lot, came down, rose, came down. And remember, after 2008, during this entire period where the US dollar went up and down, gold and silver just went up and up and up and up, went from what was it, about $1,000 or so to around about $2,000. So during this sort of period here, I think, if my memory serves me, gold more or less doubled in value despite all of this whipsawing around that the US dollar did. And finally, in 2011, around about here, gold peaked. So it doesn't peak on the first hit at the US dollar 15-year cycle low. It tends to peak approximately 3 years later. So 2026 would be, or 2027 would be the sort of period where I'd be looking to see some significant high points in the precious metals. That all makes some kind of sense. So this is all absolutely fine as long as history is a good guide. You know, we're using history as a guide here, and the US dollar, don't forget, only has 2 completed cycles since we came off the gold standard. So this chart doesn't go back quite far enough, but you can only go back to the early to mid 1970s because of what happened with the breaking up of the Bretton Woods Agreement and coming off the gold standard. So these cycles that we're looking at really only just established themselves after that. So we had a peak in the this cycle here around about 160 on the US dollar. The next peak was around about 120, and this peak around about 103 or 104, something like that. So the peaks are decreasing each time, but they're still 15 years, or rather the low points are around about 15 years apart. So we're using history as a guide here. So unless it's different this time, that's what we'd expect.
Like you say, it just adds to the weight of evidence, as you guys talk about quite a bit, right?
It is, and you know, we're not saying that this. Whenever we put our forecasts out, no forecast is 100% guaranteed. The forecast is based on a series of assumptions, and you monitor those assumptions as you go along. You know, you have your starting point, and you have your forecast, which might be a year in the future or 3 years in the future, and you have a path to get to that projected forecast point. So if we're saying that dollar is going to drop to 70, you have a path to follow to reach that point. So you have to monitor what happens all the way along that path, because if you start getting signs and evidence that you're wandering off the path, then you need to reassess your forecast. So our forecast, or my forecast, for the dollar to drop below 80 in this cycle, and probably significantly lower, my forecast is only going to look as though it's going to pan out the way I expect it to if this arc continues to hold and price starts to drop to the downside. If it breaks out, then we need to reassess that and see what's going on. And that's how forecasting works. Forecasting is not an exact science. You always have to, stay abreast of what's happening at the moment as the evidence comes in, and continually adjust your expectations. Part of that is looking at the bigger picture, and I'll enlarge this chart as well. So this is the 30-year real yield on the US 30-year Treasury note. So this is the real yield, taking inflation into account. So this is longer dated US debt, and it's much the same for the 10-year yield as well, by the way. So what's it telling us? Well, it's telling us that throughout this period here, the yield has been, or the real yield, I should say, has been bouncing around between a support and a resistance line. It's been contained by this upper line and this lower line. Point number 1, 2, 3, and 4, the real yield hit the line and then came back down. The numbers in the blue boxes are the quoted US national debt, 14 trillion, 17 trillion, 19 trillion. You can see it's been rising steadily but fairly slowly throughout the period. So what is this telling us? Well, what it's telling us is as the numerical value of the US debt increases, in order to service that debt, whether you're talking about the 10-year note or the 20-year note or the 30-year note, in order to service the debt, the United States can only afford interest rates to reach a certain point. If interest rates are higher than that, then the ability of the United States to pay the interest on its national debt becomes unaffordable unless you massively increase GDP, gross domestic product. So that's a balance, that's an equation, and you can tell by looking at this graph just where these pain points are. And this is taking inflation into account as well, of course. You can look at the actual yield to see where the real pain points are in terms of the actual interest rates. At the moment, it's perhaps somewhere around about 2.5%, certainly not as high as 3% anyway. But what's happening here is that each of these points marks a low point in the precious metals. So when the real yield hits an upper resistance line, point number 5 as well, and point number 6, it shows, or it coincides with a significant low point in gold and silver. We rose up to point number 7 earlier on this year, and that's when gold and silver bottomed and reached their low points. Now, things start to get a bit tricky now, because what's happened during the coronavirus pandemic, the global pandemic, is that due to all of the spending that's been required with people obviously having to stay away from work and have their salaries paid and all the rest of it, all the cost of the economy, more debtors had to be created to counterbalance that. And it took us to get to 23 trillion from 17 trillion, so 6 or 7 trillion increase, took us, I don't know, maybe 8 years, but we've added the same amount, 7 trillion, in a year. Mm-hmm. Which is just stop and think about that for a second. We've been adding debt at a steady rate, and everyone's been worried about it. And then in 1 year, we've added the same amount of debt that we did in the previous 8 years. So the effect that that's had is that the ability to raise rates to counteract rising inflation has been even more destroyed. So the ability of the United States to raise interest rates to counteract inflation has been eroded even more. The ability to do that is much less, because the point to which you raise interest rates before it causes pain and mathematically becomes unsustainable for the United States is now lower. That bar has been lowered, and as this number increases, 30 trillion, 40 trillion, these are numbers that I'm just estimating, but goodness knows what they're going to be. As that debt pile increases, then the number that you can raise that interest rate to comes down all the time, which is why we're living in a world of ever decreasing interest rates and zero bound rates and all that kind of terminology. So if we drop,
when you take the amount of inflation into account as well, the actual real yield is even scarier picture.
That's it, and this is the danger. The reason it's been dropping since point number 7, well, in fact, since point number 5, is because there's this growing disparity between inflation and the yield on the 30-year note. So the yield is basically not keeping up with inflation. So that gap, the difference between inflation, and bearing in mind that the quoted inflation rate in the United States and probably every other developed country is in my view, way off. If you're trying to tell me the interest rates, the inflation rate in the United States and over here in the United Kingdom is somewhere between 3 and 5%. Well, I don't know what they're measuring their numbers on, but I tell you what, the price of fuel, the price of raw materials. I've just had some building work done in the garden, and the builder was telling me, the price of timber to build garden fences and cement, to build walls and that kind of stuff, it's gone up by 40-50%, not 3-4%. So the numbers are very conservative, to say the least, but that gap is increasing. So the pressure is downwards on this real yield, and the only way that's going to break upwards is if inflation reverses or interest rates rise more to catch up with it. And I think we know the situation with interest rates. The corner that the Fed have painted themselves into with interest rates and debt. So I'm struggling to understand exactly how this can be resolved. I don't see an easy way out of this. If we head down, then it's the road to hell, because we're going to be living in this world where we're pushing the gap between inflation and the yield, the interest on the note. I mean, who on earth is going to be buying these treasury notes if interest is up here, if inflation is up here and the what you're earning in your on your purchase of the note is down here somewhere. I don't see who's going to be doing the buying apart from the Federal Reserve.
I was just going to say the Fed.
So, and what is that going to? What's the long term effect of that going to be? It's like the old, picture of the snake eating its own tail. It's going around in a big circle. I just don't see how any of that is going to end well. And if it breaks out to the upside, well, then that's the road to hell, because where's the United States going to get the finances from to pay the necessary higher rate of interest on the note? They're suddenly going to be finding themselves with having to pay, I don't know, 50% of GDP just to pay the interest on the debt. So, yeah, I mean, I don't want to depress everybody too much, but this has been known for a long time. But this move from point number 5 downwards through the apex of that triangle is extremely alarming. From a technical point of view, it screams false breakdown. It's an around the apex move down, which in the technical charting world suggests that the price is going to reverse violently to the upside. And that's kind of the natural process here that you'd normally see take place. But that can't really happen in this case because of what we're talking about. We're not talking the price of a mining company that can do that. The value of the company can shoot upwards. This is the real yield on the US national debt, who happen to be the world's reserve currency. So it's a completely different situation. The only way is down, probably, unless you want, I mean, as I say, road to hell number 1 or road to hell number 2, take your pick.
So, Kevin, when we think about the relationship of the 30-year note compared to gold, does that relationship tend to break down over time, or let's say more recently? Or if you take this longer term view, as you give us this big perspective here, does it seem to respect it with, let's say, short term discorrelations?
Well, I'd say on that is that short-term discorrelations tend to iron out in the longer term. So all of those points from point number 5, where it fell away, the gold and silver went up, and then sorry, I beg your pardon, gold and silver, yes, went up, and then the price of gold and silver dropped again into point number 6, and then regardless of all the small fluctuations, the price of gold and silver then rose again. And then turned around and dropped into point number 7, and now we've been rising again, albeit sort of. So this point here on the chart is March of last year. So August, when the August last year, when the price. Let me get this right. Sorry, I'm looking at the wrong year, aren't I? So the August 2020 peak occurred here when it bottomed. So you see how you got the gold and silver price bottom, and then down here you've got the gold and silver price peak. Okay, and then you got the gold and silver price bottom as it hit this line here. Now we could be coming up again to sort of test the line, which might explain why what's going on at the moment. So it's possible we could be coming back up to have another retest of this resistance line, which would give us another drop. And indeed, we have been dropping. So from August of last year, which is here. So after we hit this level here, the price of gold and silver has been dropping away, and it's still dropping away. So we need to sort of break this line decisively and drop away to the downside to sort of have this as wind in the sails for gold and silver. If we go back up to retest this line here, then it makes a lot of sense that gold and silver would show weakness. The real yield, by the way, is quite a strong force. When you look at the correlations, it probably has a stronger effect on gold price than the US dollar does, or certainly is equivalent. I mean, a lot of people would assume that the US dollar drops and gold goes up. That's not quite the case, because real yields are a big part of the equation as well. So you have to factor that in. If you have the real yield dropping and you have gold dropping, then that's a huge tailwind, sending precious metals higher. but in other scenarios where one's dropping and one's falling, they have slightly different sort of push and pull effects. So you need to sort of do a lot of technical chart analysis to weigh up which is the stronger force out of those. Yeah, a lot to consider there. I think finally was the last chart we were going to look at was uranium, wasn't it? I think, Tom. I'm going to take a look at uranium. So I'll just enlarge the chart there. So this is the uranium spot price, and this is another commodity, of course, a bit like copper that's been spiking relatively recently, and lumber has been seeing a price spike. This is uranium, which actually broke out from its technical chart sort of downtrend back in 2018. It came back to back test. So this is uranium spot price. This isn't the miners, it's the actual spot price of uranium. Came back down to sort of make a technical back test, as we call it, of the support line through last year. And it's been in a generally uptrending channel ever since. You see all these repeating patterns. If I just zoom in a little bit, you can see these repeating patterns here where the spot price of uranium goes up and it drops, goes up and it drops. And there's a certain amount of seasonality in here, but it's not a strict correlation. It's not just simply that the price of spot uranium goes up at a certain time of year. There are other sort of factors at force, but you can see these generally repeating patterns. So we've risen out of the most recent one, seeing a little bit of a back test here and a pullback. It would not be unusual or unexpected or anything out of the ordinary to see the spot price of uranium come back and test somewhere around about $31, I suppose. If it fell vertically from here, it would be somewhere closer to or just below $30, perhaps. But the overall big picture is contained within this arc formation, and as I sort of said before, they tend to be very, very reliable. So this is our roadmap for spot price of uranium, with a breakout perhaps occurring sometime later next year, or certainly by 2023. And it would be very common whenever we do break out to see a back test before the move up into the target area in the top right hand corner of the arc. Once you've achieved the target, several things can happen depending on where you are in the cycle. Everything has a cyclical nature to it. You can do what sort of happened with Bitcoin and see the price sort of continue upwards out of the initial arc and to a higher level. Same thing happened with Ethereum, actually, was probably a better example. Ethereum reached its arc target and then continued higher. So you can do that, or you can also build what some people refer to as a handle, and the price comes down out of the arc, forms a downtrend for a period of time before resuming the uptrend once it's hit its cyclical low. Depends where the cyclical low is. I've mentioned that 2024 is a low point for probably. I'd have to have a look at all of the commodities, certainly gold and silver and some of the other commodities. I'd expect to pull back into that sort of period close to the US election, actually, in 2024. So somewhere around here, we ought to see the price pulling back. So perhaps we'll break out to the upside and then come back down. But we'll look at that nearer the time. It's far too early to be looking at that now. So that's the roadmap anyway. That's my roadmap for the uranium price, Tom.
Excellent, Kevin. Yeah, it's interesting to see that it is really, for the most part, respecting that arc.
It is, yeah. And as I said before, the arcs occasionally fail, not often, but it's a roadmap to be followed. And all of these sort of large roadmaps are there to give us a background view of what's going on. When you're looking at individual miners, you might be looking at an individual uranium miner like, I don't know, let's take a look at Energy Fuels, for example, EFR. Choose the one on the Canadian Stock Exchange there because I've drawn the arc on that one as well. So you can look at the individual miners, and when you're trading these things, we've myself and Patrick Karim have developed for sort of subscribers to our website there. We've developed this sort of charting technique that's quite heavily based on Stan Weinstein's methodology of stage analysis. Stage analysis, if you're not familiar with it, is this idea where you have a basing process, stage one, that takes place, and this ties in with the arc that I've been drawing for a number of years, reading Stan Weinstein's methodology now, it's quite reassuring to see that his work sort of ties in with my own, even though I was unaware of what he did. The stage 2 uptrend is where, the big profits are to be made, and you have to spot this distribution pattern. Also sort of ties in with the Wyckoff distribution pattern that some listeners might be familiar with. All of these different theories and different, in my case, I draw the inverted arc. All of these theories and methodologies are all actually the same thing. They're all describing the same chart patterns in a slightly different way. So you have the stage 3 top or distribution pattern, and then the stage 4 decline markdown, as it's called on this diagram here. And then the whole thing repeats again, and you're into the stage 1 accumulation period. So to use that kind of methodology on the energy fuels chart, we have adapted that methodology to an extent. And what we've done, and some people might like to kind of use this as a way of knowing when to buy and sell stocks, for example. You can see this green area that's indicated at the bottom of the chart, and it flashes up green when this is the Mansfield Relative Strength Index, and we're comparing the strength of energy fuels or the performance of energy fuels to the SPX. You can set it to compare it to the performance of the sector ETF, uranium ETF. And what that does is basically it helps you to pick a stock that is outperforming the ETF. So if you're using the HUI index or the GDX index, you could compare your stock to the GDX and pick the stocks that are outperforming the GDX, because obviously that's what you want to do. So it flashes up green when you're doing that, but also critically, the other thing that makes this flash up green is that you have to be above a rising 30-week moving average. That's the Stan Weinstein methodology. You don't enter a trade until you're above the 30-week moving average. So at this point here, you get above the 30-week moving average, and you can tie it in with a technical chart analysis. You see that I've drawn a resistance line on here. So the technical chart analysis helps us because we bounce off the arc through the resistance line above the 30-week moving average, and this flashes up green because you're outperforming the SPX. So you've got a series of indicators that are saying buy, 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 and you're not just relying on one particular method or one methodology. And simply you sell when you drop down below the 30-week moving average on a weekly closing basis. So you enter when the candle closes a week above the 30-week moving average, and you exit when the candle closes a week below the 30-week moving average. Now, as it happens, I've not exited on this because this is the standard backtest, and I'm using the technical chart analysis to sort of hold my position. Sometimes these backtests, they will come back down below the 30-week moving average and cause you to exit the trade when perhaps you don't need to, because all it is a backtest. So I'll exit energy fuels if the support line's broken, but it hasn't been. So my expectation is that price is going to either bounce back up above the 30-week moving average or slide down this support line. Either way, we've got a very large arc that's going to guide prices much, much higher in the longer term. So that's the methodology for the NSBC trading system, the North Star Bad Charts trading system. It's based on outperformance of the sector being above a rising 30-week moving average and having a technical breakout. Oh, and of course, the other thing, which I didn't mention, you have to have a volume candle as well. So you need that volume candle there to be significant on the breakout. So you see the breakout here on that line, and also the breakout on this line here. You've got a sizable volume candle, and the initial breakout needs to be a candle that's roughly twice the size of the previous 4 candles averaged out. So these candles here, when you average the volume on those 3 candles, if your breakout candle is double the average of those, then it's a confirmation of the breakout. So it's those factors combined that would lead us to put something in the NSBC green report, which goes out to subscribers, and that gives you a relatively safe entry, and it's kind of minimizing your risk. And from that point onwards, you just ride the trend and manage your exit point however you want to manage it. There's a number of ways, as I've said.
Excellent, Kev. Yeah, it's quite interesting, as you say. You really stack up the weight of evidence, and you have several different data points to confirm that move, right?
Yeah. If you're just relying on one factor, if you're just relying on, we've gone back above the 30-week moving average, well, that could be, not very good, because here we went above the 30-week moving average, and then price went from, what was it, $4. It went all the way down to $1. So just being above the 30-week moving average isn't enough. It didn't break above the resistance line.
No volume associated with that.
No volume, no big green volume candles. We didn't break the technical resistance line. We flashed up green on the bottom here because we were the 30-week was rising slightly, but we didn't have all of the confirming factors that we needed. And so, it wouldn't have been a recommendation on our green report. It has to meet all of the criteria. And then me and Patrick have a conference call and kind of knock our heads together and, also give it a bit of a sort of common sense discussion to decide whether we think it makes the report or not. But it has to meet all of those criteria, otherwise it's not even considered. Which is why at the moment we've only got four stocks in the report. The gold and silver sectors, which a lot of people might want to be sort of getting into at the moment. It's nigh on impossible to find stocks that meet these criteria at the moment. So in the future, yeah, great, but we're not going to sort of recommend things that aren't on secure ground at the moment.
Mm-hmm. Yeah, and you just have to really confirm that move before it is a recommendation, right?
Yeah, absolutely. Well, yeah, if you've got people who are perhaps acting on what you're saying, then you need to be pretty sure. And we're not really taking the route of micromanaging people's portfolios. That's something that has to be done according to people's own risk tolerance and whether they like to take risks or whether they don't, and you manage your own stop losses and all that kind of thing. So really don't want to go down that route. We're just wanting to put these stocks in front of people and say, look, they meet all of these criteria. If you want to buy them, go ahead and buy them. This is our methodology. We've explained it all for you, so the techniques that we're using for the entry point, the techniques we're using for the exit point. If you're happy with that, then great, use it. Me and Patrick are using it. We're taking positions in all of the stocks that we recommend. So we're putting our money where our mouth is, which might reassure some people, hopefully.
Mm-hmm. Excellent, Kev. Do you have anything else you'd like to touch on before we wrap up here?
I think that's about it. Just anyone that's watching this that hasn't joined our site yet, then feel free to join us. You can also look at our free stuff as well on Twitter. You'll find myself, North Star Charts on Twitter, and Patrick Karim on Twitter as well. Bad Charts 1 and northstarbadcharts.com is the website. So feel free to take a look. And also, actually, if you want to take a look at if you're a bit kind of, this technical analysis is all a bit weird and I'm not sure if I believe it or not, just go to my free site, which is northstarcharts.com. And I've put on there, it's a kind of an archive of all of the back catalogue of my calls on uranium, the US dollar, gold, silver, cryptocurrencies. So you can go back to last year and the year before to see, okay, what was Kevin saying? What did he say about, what was his technical analysis saying about all of these markets and what happened? Were they right or were they wrong? So all of the back catalogue, all my archive of calls, they're all there on northstarcharts.com. So feel free to go there and have a look around.
Perfect, Kevin. Thanks so much for your time and your thoughts today.
Okay. Thanks a lot, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.